financial results. There's basically two groups of users: internal users and external users. So let's separate these because they come at the viewing of the financial reports very differently. Internal users, those are people within our organization, from our board to our executive management, to our senior management, to operating management, down to any line manager, and in some organizations, down to the individual employee, looking at what have we produced? What have we produced compared to what we thought we would, what we committed to? What was our budget? Did we achieve the production level that we expected, the revenue level? Are the costs what we expected them to be? Are the costs in line with not only our plan, but industry metrics, benchmarks, if you will? So internal users of financial information, particularly the financial reports, in most cases is more of a concern to accounting than even the external users. And this should be pretty obvious. Our accounting department, our accounting staff, is going to work with their peers, the internal managers, every single day. And we're all working towards the same goal: achieving the objectives set out by the organization. So frequently, when internal financial reports come out, the financial statements, the internal managers will review them. If they have questions, and they will always have questions, they can go directly to their accounting department and sit down and discuss the questions, the interpretations. Why are certain things reported in a certain way? Why did we miss a target from a reporting standpoint when from an operational standpoint we thought we had achieved or even exceeded the target? So it's a very important use of our information to help us understand how our business is actually running, if we need to make any changes or adjustments, and if so, what changes and adjustments do we need to make? So these reports come out very frequently, and they follow a form of accounting called managerial accounting. It's internally focused. It has slightly different terminology than the financial accounting that we'll talk about in a moment. And we find that it's more precise in reporting transactions internally than the financial accounting is externally. And again, we'll dive a little deeper into this in some subsequent modules. So that's the internal use of our financial results. So let's take a moment and look externally. We report our financial results externally to a variety of entities. Virtually all of us have to report to the government, whether it's for tax reasons or any other. There may be regulatory agencies that require information from us. There certainly are our investors and our lenders, those providing us with capital, whether it's debt capital from the banks or equity capital from any of our investors. They're going to want to see how well we're doing. Are we achieving the goals that they had set? Remember, investors are providing us capital with the anticipation of either a cash dividend or a growth in the value of their shares. That's only going to come if we meet or exceed the goals we set. So they're always looking at this. From a lender standpoint, they always want to make sure that we're able to repay the debt that they provide us. So each is looking at our financial statements slightly differently, and sometimes the various parties, government, lenders, investors, etc., will look at different parts of the financial statement to look at what's important to them. There are two other parties that frequently look at our financial statements from an external standpoint. Those are both our suppliers and our customers. Now, some of you may be thinking that you might not want to share your financials with suppliers and customers, or they've never asked, and that's fine. What we find frequently is the larger the customer, the larger the supplier, the more they are reliant or dependent on our performance, the more interested they are in our financials. So let's look at our suppliers first. Why would a supplier care about our financial results? They care because they want to make sure that we will pay them for what they produce on an as agreed basis. So particularly as the relationship grows, they want to make sure that we'll be in a financial position to pay them. So we reverse that when we look at customers. From the standpoint of our customers, they want to make sure that we can supply them as their needs grow or as we change them. So we have two very important external groups in addition to lenders, investors, and the government. Those are our suppliers and our customers. So let's move on to cash accounting versus accrual accounting. Cash accounting is the form of accounting that we have been using for 500 or 600 years. It basically is where you have cash coming in as we make a sale, cash going out as we pay an obligation or acquire an asset. Cash accounting is what many, many organizations use, particularly if they're on the small side. Very simple. When I was young, very young actually, I went to work with my grandfather who owned a lamp store. He literally made lighting lamps by hand. And I asked him, as I was looking up at him and seeing everything that was going on in the store, "Grandpa, how do you know you had a good day?" And he said, "I walk in the morning and I count the cash in the drawer. And when I leave at night, I count the cash in the drawer. If I have more cash at the end of the day than the beginning of the day, I had a good day." Well, that's basically cash accounting. And small organizations, many of them, use cash accounting because it's simple. Literally, as we make a sale and get paid, we record that sale. As we pay an obligation and the cash goes out, we record that cost. If we buy an asset, when we receive the asset, a small machine. When we pay for that, that's when we record the actual cost. So cash accounting seems very simple. It's very straightforward. So why doesn't everybody use cash accounting? Well, there's really two reasons. Number one, it is subject to manipulation. And what I mean by this, and this is where the government frequently gets a little concerned, if we've had a very, very good year and we're approaching the end of the year, we say, well, even though we have more checks coming in, if we don't cash those, if we don't put those in the bank, we don't have to record that revenue, and we already have planned for what our tax obligation might be and what the reported profit will be. So we'll hold those until the very next period. Or reverse that. Same thing with obligations. If we don't pay a bill, if we don't pay a debt today, we put it off till tomorrow or next week, then we don't have to record that expense. That's the real challenge with cash accounting. It is very easily manipulated by an individual entity. So that's one reason why some organizations don't use it. The other reason is in most countries, once our organization reaches a certain size based on revenue or number of employees or a few other criteria, we're not allowed to use cash accounting. We must use the other form of accounting.